Understanding the spirit of Murabbaha. Many financial institutions commit mistakes in interpreting the spirit of Murabbaha. The most common mistake is using Murabbaha for all types of transactions and financing. Murabbaha can only be used where there is a tangible item intended to be purchased by the buyer. For example, a factory can avail Murabbaha to purchase raw material like yarn, but cannot get money to pay salaries or electricity bills. Another mistake often committed is when a bank sells an item before it is actually acquired from the supplier. Murabbaha financing cannot be implemented on items that are already purchased by their clients from the vendor. If the bank purchases the item from the client, then it is a buyback scheme, which is not permitted by Sharia. Another possible mistake is that the bank appoints the client as an agent to purchase the goods. The client purchases the goods as an agent and uses it without executing the actual Murabbaha sale. This sale is not valid. Let's recap what we have learnt in this module. The concept of Murabbaha, a cost plus sale. Murabbaha is a transparent sale. Here, the seller has to declare the costs incurred in acquiring an item to be sold, in addition to a profit which will be mutually agreed upon with the buyer. A Murabbaha transaction in which the sale price is agreed to be paid in lump sum or in fixed installments on a deferred basis is called Murabbaha Muajjal. We learnt about the steps required to carry out a Sharia-compliant Murabbaha transaction. Rebates on early payment of the Murabbaha are considered non-Islamic. Also, penalties levied by the bank for late payments, if made part of the bank's income, are also non-Islamic. All Murabbaha transactions are fixed-rate products, and a rollover in the transaction is not permitted. We also learnt about the various steps taken by the bank to protect itself from willful default by the client. Some common mistakes made in the interpretation of Murabbaha were pointed out. Murabbaha schemes are presently used to finance purchase of automobiles, houses, goods, equipment, furniture, or any tangible thing of value from a third party. You may now reinforce your learning by going through this topic in the illustrated textbook and check your comprehension on the subject by attempting the questions in the workbook. Our next module will introduce you to the concept of ijara. Brief analysis of risks in Murabbaha. There are many risks for Islamic banks in Murabbaha. Imagine what will happen if the price of the car changes before sale to the client. Any damage to the car before it is actually sold to the client is also the bank's responsibility. These risks will increase the longer the car remains in the ownership of the bank. Without even knowing you, we run the risk of your failure to pay on time or default, the late payment risk. The late payment penalty does not become a part of the bank's income. It has to be given to charity. Murabbaha is a fixed return type of finance and is exposed to return rate risks. If the bank sells the car for a credit period of 5 years, it cannot increase the price even if the general prices or the profit level in the market or the benchmark in the banking sector rises. As against this, in interest-based banks, the rate and the amount payable by the client goes on increasing with the market rates. Some related issues. The marked-up price, once agreed upon, cannot be changed. This is a sale, and once the deal is finalized, the ownership of the sold goods and the risks and the rewards associated with it gets transferred to the buyer. The seller has the right to the credit price that has been agreed upon. This is also to avoid any gharar between us. Similarly, rollover Murabbaha is not allowed, as it means that the bank is getting interest on the debt that it had created by way of Murabbaha. Murabbaha cannot be used for paying bills. That is not permitted. Let me clarify. Assalamu alaikum. Welcome to the e-learning program on Murabbaha. In this module, you will learn about the concept of Murabbaha, the process of a Murabbaha transaction, repayment of a Murabbaha, the options open to the bank in case of willful default by the client, brief analysis of risks in Murabbaha, some related issues, understanding the spirit of Murabbaha. The concept of Murabbaha. Murabbaha is a financing technique used by Islamic banks to help customers purchase various assets. Salman, a marketing executive, is shopping for his first car. Hello Salman, please be seated. Murabbaha is an ideal scheme for purchasing cars. Are you familiar with this term? In its pure sense, Murabbaha has nothing to do with financing. It is an Islamic term referring to a particular kind of sale transaction. A normal sale transaction in Arabic is called Baya Musawama. In Baya Musawama, an item is sold at a price on which the buyer and the seller agree after bargaining without mentioning the actual cost incurred by the seller. If the seller discloses the actual cost price of an item to the buyer and they both agree upon an amount with a profit margin, it becomes a Murabbaha transaction. The word Murabbaha is from Rib, meaning profit. Suppose you want to buy a commodity, but you're not in a position to buy it directly, either due to lack of expertise or due to shortage of funds. You can then buy it from us on a Murabbaha basis. If I sell you the commodity after disclosing my profit in the sale, it is a Murabbaha transaction. In Murabbaha, payment can be made on the spot or on a deferred basis. If the payment is deferred to a future date, it becomes Murabbaha Muajjal. Since most sale transactions by Islamic banks happen this way, it is commonly called as Murabbaha, meaning cost plus sale. In some cases, the Islamic bank may not be able to purchase an item due to lack of relevant expertise. Suppose you want to buy a ton of steel. The bank may not have the necessary expertise in-house. I presume in such a case you will have to appoint an expert as an agent to purchase the steel on your behalf. Yes, you're right. The agent may be a third party or the client himself. Sharia scholars advise that appointing the Murabbaha client as an agent should be avoided as far as possible, as this is likely to become a backdoor for interest in the form of trade. Remember, Islamic banks engage in buying and selling. Financing is merely a byproduct of a trade transaction. Murabbaha is used to finance purchase of automobiles, houses, goods, equipment, furniture, or any tangible thing of value from a third party. The bank may purchase a car from the showroom and then sell it to you on a cost plus sale basis. This is called Murabbaha to the purchase orderer. If you buy the car from the Islamic bank at an agreed price and pay in lump sum after say 3 years or in 36 equal monthly installments, it becomes a Murabbaha Muajjal transaction. The marked up price in a Murabbaha transaction will depend on several factors, but generally it is marked to the market. Since we are in business, we cannot afford to be less competitive. However, Islamic banks do not charge more than the other banks and their prices are competitive. Also, unlike in a conventional mortgage, in Murabbaha there is no question of Reba involved at all. That is why Murabbaha is such a popular mode of financing. The process of a Murabbaha transaction. There is a logical sequence of events with relevant documentation. Here are the steps required to carry out a Murabbaha transaction. Since you have decided on the car model, apply with us for purchase of the car. Specify the make, model, and the price of the car, and by what time you intend to settle the payment. Since the payment is deferred, a credit evaluation has to be made. We need to know your income and probable cash flows to determine your repayment capacity. We will both agree on the profit margin to be loaded on the cost of the car. Since the Islamic bank will purchase the car based on your application, you will make a promise to the Islamic bank to purchase the car once the Islamic bank has purchased it. You will have to make a down payment to show that you are serious about this transaction. This down payment may be in cash or some other liquid asset. This is normally about 10 to 15% of the cost of the asset. In case you dishonor your commitment to purchase, the down payment will be used to compensate the bank for actual loss to the bank, if any. The bank will then purchase the car and pay 70,000 dirhams to the dealer. The dealer will then transfer the ownership to the bank. Once the bank takes possession of the car, you will sign a sale contract whereby we will sell the car to you at an agreed marked up price. That's the contract price. You now have your car and you will be indebted to the bank to the amount of the marked up contract price. Since the payment for the car is deferred, you will sign an agreement on the nature of security for the credit. In this case, it can be the car itself that will be mortgaged to the bank. Alternatively, the security may be from your existing assets, or the bank may ask for a guarantor who will be liable to pay in case you default. The security or collateral may also be any combination of the above, as we may mutually agree. No, you cannot take the car directly from the dealer. In Murabbaha, the item has to be in the possession of the bank before being transferred to the buyer. If there is a loss or damage to the car after the bank has taken its possession and before its sale to the client, the bank will bear the loss. In that case, the bank has two options. The bank has two options if the client fails to purchase the car on time. Option 1. The bank may resort to the khiyar-e-shart with the car dealer. If the client does not purchase the car, the bank will have the option to cancel the sale with the car dealer within a specified number of days, say 3 days. Option 2. The bank may sell the car in the market. If the bank incurs any loss, it can recover the loss from the down payment that it has taken from the client. Repayment of a Murabbaha. You can repay in equal monthly installments for which we will accept post-dated checks. This is also called Beer Bitaman Ajil, which is a deferred payment sale at the duration and price agreed to by both parties and is payable in fixed installments. Rebate on early payment is considered non-Islamic. Murabbaha is a trade. Here, the prices have to be fixed once and for all, and the debt created cannot be increased or decreased, keeping in view the time of actual payment. However, even if a prepayment rebate is not agreed upon in the Murabbaha deal, the bank can give a rebate at its own discretion. Rebate is not a right of the buyer. Islamic bank can consider giving a rebate to its clients as an act of benevolence. Similarly, the bank cannot charge more than the agreed amount of Murabbaha price even in case you delay the payment. Otherwise, it will be Reba. The options open to the bank in case of willful default by the client. In the Murabbaha agreement, the bank puts some conditions to discourage late payments or defaults by clients. In case of willful default, the client must pay a late payment penalty that goes to charity. If a payment is defaulted, the remaining installments would become due with immediate effect. If the client does not pay even then, the bank can liquidate the collateral to recover its due amounts. An introduction to Reba. Faith in Islam prevents Muslims from borrowing money on Reba. Islamic banks have now structured banking products and services that are halal or permissible under Sharia. Let us meet Azim and Hamid, two good friends. Both are devout followers of Islam and would not do anything impermissible or haram in the eyes of Sharia. Riba is the Islamic term for interest. Sharia frowns upon riba in any form. Azim or Hamid would not deal with any interest-based transactions. Before Islamic finance came into being about 30 years ago, only the very rich could really afford to purchase homes or realize their dreams. Since borrowing on riba is equivalent to declaring war against Allah, poor men like Azim or Hamid could hardly find the large sums of money necessary to fulfill their dreams. Islamic financial institutions today are creating a wide spectrum of financial products which are halal. Now, both Muslims and non-Muslims can approach any Islamic financial institution as they offer a range of banking products and services. Principle of Ta'awun. From childhood, the principle of Ta'awun, that is, mutual help or cooperation, has been taught to all Muslim children. They learn to help each other in times of need and grow up as a large, happy family. Ta'awun in Islamic finance allows participants to make donations with the intention of helping one another within the group. The concept of Ta'awun can be broken down to the following: mutual responsibility, mutual cooperation, mutual protection. These principles that are the part and parcel of Sharia are the basis of family and general takaful, an alternative to the conventional interest, gharar, gambling-based insurance system. All Muslims can get takaful cover against possible losses to life and property on mutual sharing and cooperation basis. They can manage to help one another in case of losses or harm to any of them. Islamic banks and financial institutions seek to abide by the Islamic principles by developing financial products and operations that have the nod of approval from Sharia scholars. These are only a few of the transactions that devout Muslims would find available in Islamic financial institutions today. Murabbaha, Qard, Tawarruk, Ijara, Mudaraba, Musharaka,